All right, well, let's get started. I've got just a few announcements for Janie does her thing. So welcome to the call. Just so you know what's happening this week, noon is the attraction training. 1 o'clock Eastern is the real estate B school portion, $1 million agent method. And then Tuesday is our new collaborative mastermind, and Liz Cruz is going to be on, and she is in the land and ranch division, and she's going to talk about it and what they all have, how you can use it, even if you're not like she uses the example, even if you're not a horse person, like it's not just for that. And they've got so many great tools. She's super excited about it. It reminds me, Janie, when luxury was like getting going, and it's so cool. So be sure and attend Tuesday, especially if you know nothing about it, because you may be talking to other agents that want to know about it. And it's just good to understand all the tools and options we get here at eXp. So that's tomorrow at 1 o'clock. You just go to collaborativecall.com. Liz also did a video in the Facebook group, Game Changers Facebook group. So if you want to get like a little pre intro to it, she did a video. And we've got some new members, Joshua out of Tennessee and Kimberly out of Virginia, that Melissa and Garrett both sponsored. So welcome to them. And FastCap, we have an evening class starting here in 2 days. So if you have not taken FastCap, it's for any agent. It's, I would say it's to help kind of get back on track or increase your sales, or maybe just kind of get a refresher of something you could do. So FastCap, June 4th through July 11th. They will also teach you how to use Sisu, because they use that in there. Oh, one slide we don't have in here, but if you guys saw your email, we have now the CRM of choice. So at eXp, you're going to be able to choose your CRM between Bold Trail, which is KV Core's new name, Lofty, which formerly was Chime, and then Cloze, Cloze. They are going to be doing some training on it so you can help decide. But once you choose, that's your CRM for the year. So you can't kind of like flip back month after month. So it's worth it to check it out. Use those training sessions to see what you like. And then you can choose which CRM you want to use. So super cool announcements there. There was one other announcement I saw this morning in my email, but I'll take a look. We can talk about it next week. But when you see those emails from eXp, do read them, because they really do have a lot of good information for us regarding things like this, new tools, new trainings, stuff like that. So, all right, Jeannie, I will let you take it away.
Awesome, awesome. I'm so excited to give this topic. Let me share my screen. Let me scoot so I'm kind of out of the way here. All right, can you guys see my screen okay? Yep,
Yes,
you're
we
good.
can.
Okay, awesome. I'm I'm a uh one screen kind of person, so it normally takes me a little bit of setup to get things set up. So hold on one sec. One day I'll have um both of my two screens one day when I grow up and be a big girl. So hold on sorry guys. I had it all set up and here we are. All right. I was gonna say I will keep my chat open, so if you guys have questions, and then we'll try to save some time at the end for chat. And then I also have a little PDF accompanying sheet that I'll give Lovely to drop in there. So I really wanted to talk about all the different creative financing options for real estate agents to themselves build their own portfolio, because we're in real estate all the time, day in and day out, but we have such a small percentage of real estate agents who are actually real estate investors and property owners besides their house. And in my opinion, and this is just me, it's we're so uniquely positioned to invest in real estate because we have the inside scoop, we have the conversations, we have the relationships, but a lot of people either think they can't or it's overwhelming or all kinds of things. So we're going to talk about that today. Um, so, a lot of agents struggle because their own tax strategy is that they write off everything, right? So they have kind of low income taxes compared to what they really made. And so it makes traditional financing a little bit more challenging. And a lot of agents who are so busy doing all the things with real estate, they don't take the time sometimes to look into all the other alternate ways to find financing funds to finance their real estate investment. And I'm one of those people. In the last, let's call it 7 years, I've bought 14 homes and none of them were with traditional financing. And I've used almost every financing that we're going to talk about here. And I've just stumbled my way through it. Like nothing is perfect. We're always waiting for like everything perfect to line up, or we get obsessed with points and interest rates and all that stuff, which is different with creative financing often than it is with traditional financing. But all of that, when you weigh it out, can often make a lot of sense still to move forward. So like I said, I actually do these things. I'm always looking for options and I'm always looking for the way to make something work, right? A lot of people, our default is that won't work, right? It's a way for our brain to kind of protect ourselves. And I really never think that way. I'm always like, how can I make that work? Maybe a little bit delulu about it, but it always works out. I'm like, how can I make this work? And I don't give up and I press on and I press on. So um, investing isn't really made for investing with traditional financing isn't really made for entrepreneurs because of the way we do our taxes. But there's lots of solutions out there, and I really want to kind of make us work. Hold on, I'm still having a little bit of a hard time. There we go. Um, I just want to work on how we can kind of shift our mindset about all of that. And so that we can start looking for those solutions. And maybe you too can be like a little delulu, like I am delusional, like I am about how can I make this work? How can I think outside the box? Um, and access all the special things that we have as agents, which is, we have access to deals, we have access to sellers, we have all these great programs. We are coming in contact with lenders all the time. And often we only think about talking to lenders about our clients and not about, solutions that they might offer. So there's a whole bunch of ways. I'm not going to cover everything in this training, but I'm going to cover kind of the most obvious or easiest things that you might have access to. First of all, non-QM loans. We're going to talk about that, what that means. There are investor-friendly lenders out there, lenders who do not lend to people buying homes for their own personal residence, but only for investment. There's private financing. There's hard money. There's private financing that's not the same as hard money. It's like in between the two. There's seller financing, there's house hacking. And like I said, you have such a unique access to everything as an agent. It would make a lot of sense if you think, how can I kind of put my little spidey sense on to keep my ears to the ground about deals, about opportunities, about lending solutions and things like that. So let's start with non-QM loans. That's kind of the most obvious because normally the lenders you're already dealing with for your buyers, often, if they're not the direct lender, like they're not the direct bank, but they're mortgage broker, they probably have non-QM solution. So what non-QM means is non-qualifying mortgages. They don't follow the same strict government guidelines because they are not going to be backed by Fannie and Freddie. But they still have guidelines and they still often sell the mortgages on the secondhand market, or they have servicing companies come in, but they just qualify differently than traditional banks. They have things like bank statement loans or 1099s, or they look at assets. There's something called a DSCR, which means a debt service coverage ratio, where if you're buying something, they can look at the expected rents on that and lend based on the rents, the what's called the debt service, the rents how it's going to be covered. How is the debt going to be covered by the rents alone and not part of your income? There are bank statement loans where they just look at your income, like your money coming in. They don't even look at your expenses. So if you're like, oh, well, I run all these expenses through, they don't even look at that. They just look at your bank statements, and they'll average them out over 12 months, or they'll average them out over 24 months, and they'll take that average, and then they just apply a standard percentage of what they think the typical real estate agent will have as far as expenses. And then they use that as your income instead of having tax returns. There's portfolio loans. So if you work up a good relationship, say with your local credit union or something like that, a lot of times they will hold the loans themselves in-house, meaning they don't sell them off to the secondary market. And they are often more based on relationships with somebody long-term than with, somebody where they're just going to sell the loan. So those are some of the most obvious, and easy to tap into solutions. I've bought the farm I'm in now was with a bank statement loan. I refinanced out of another property and pulled the money out of that to put the down payment on. So I've just literally kind of rolled everything forward to keep improving, improving, improving. And now because I'm a farm, I have special also benefits because I have tax benefits. I can have income on it and things like that. So I'm really trying to encourage you guys to be thinking outside the box of real estate as your long-term asset building. And yes, the rates are higher, the fees are higher, you have that, but also you're not paying. The reason that you have that is you're probably writing everything off that a regular person who has a W-2, they can't write those things off, so they pay a higher tax. You pay lower tax because you write everything off. So it's kind of offset like that. We can't think about trying to compare a non-QM loan or a private money loan in the same way we would compare a traditional conforming loan as far as rates and points, because they're taking a little more risk, so they're going to have higher rates and higher interest, but at the same time, you're now able to get into these properties that you wouldn't otherwise. And I've closed on properties with this non-traditional financing, not a non-QM loan that's almost kind of like a regular loan, but with private money in as little as 3 to 5 days. So if you come across something and you've already kind of worked up and built up some relationships, you might be able to call them up and get funding, like I said, in 3 to 5 days. And we'll talk about that here in a minute, but I just really want to encourage you to start kind of thinking outside the box. So again, tax returns don't matter. So if you're really good about writing everything off, or your accountant is, keep doing that. Just remember, there's other ways that you can buy. Now, the pros are easier approval. They're often just approving the asset. The cons are higher rates and fees, but in the wash, it all washes out. I've had interest rates as high as 11%, where the mortgages at the time were 3 or 4%, and I didn't blink an eyelash about it because I knew I was getting a great deal. I was getting a great opportunity. There's a great upside and appreciation to what I was buying. So private financing is when you're dealing with either an individual person or something like that that's not a lender company. It's normally a private person. Or some kind of private group of people. Sometimes they'll bundle together because those are really great investments too. Maybe we'll have a whole separate conversation about how you can become the lender to other people for asset-backed investments, which is how a lot of really rich people make their money. But so they base their decisions on the asset itself, the property themselves. Relationships often become really, really important. Relationship with mortgage brokers who have the relationships with the individuals who have this money, or over time, you might develop some relationships with those individuals that have that money. I've done it a lot. I've set up different clients of mine with private money. You're normally going to pay several points up front. They'll roll that into the loan. And like I said, if you're buying right, it all kind of washes out. And the money, like I said, is fast. And if you build a relationship, it can become, like I said, just a phone call where they're like, sure, what's the address? Let me check it out. And they might fund you in 3 to 5 days. I bought several properties with private money. There are investor-friendly lenders, so true lending companies. who are used to only funding. They don't fund private residences for people. They only fund individuals. And they often have a sliding scale with their points and their interest based on how many transactions you've done, like in the last year, either on your own or with them, so that they see that you have the track record, meaning you're going to pay more points, higher interest if this is your first deal than if this is your fifth deal with them, or your, fifth deal in the last year. It really, because you're showing your competence in being able to find good properties, do what needs to be done. If you're flipping them, if you're refinancing out, a lot of times what you'll do is use something like private money or investor money to buy, and we'll talk about this method here in a second, to buy a property that maybe needs work. You'll buy it, you'll renovate it, you'll get it rented out, and then you'll refinance out with a more traditional loan. And that might be like that DSCR, that debt service ratio coverage type of loan. That's a long-term, 30-year loan, something like that. Lima One is a company, if you guys are wondering who does that, Lima One is a company that really specifically works with investors. But it's important that you're not just shopping rates, you're not just shopping points, because like I said, it matters less, because these are often 12-month loans, 24-month loans, kind of shorter terms. So it matters less about that and more about building long-term relationships where you can call them if you find another deal, and in a rather short time be able to fund your deals. They're really good about understanding what investors need. They're really good about analyzing that. They're a lot more flexible with their underwriting. They might have, again, non-QM, DSCR, private loan, things like that. They might have a whole suite of loan products that they could deploy, but it's really important to start building relationships with somebody. And they can help you structure deals together with whatever you've got going on. So seller financing is another great deal. Like, there are sellers, everybody always thinks that what sellers want is to get the most money for their property, right? That's not all, especially with investment properties, that's not always the deal. They might be just sick of maintaining the property. They might be sick of managing tenants, but they liked having that passive income. So they might be happy to do seller financing because they'll continue to get that passive income through your mortgage payments to them. They basically become the private lender. They become the bank. They might be able to get more money for their property through seller financing. That's often kind of the trade-off, right? Or they just don't want to mess with it. Maybe they inherited it and it's got a lot of warts on it, so to speak, and they just don't want to deal with that. And you're like, okay, hey, will you seller finance this for the next year, 2 years, whatever it is, let me get everything done that I need to do, and then you could potentially refinance out. I've gotten seller financing also, though, for 30 full years, which is like the best of the best, because then you don't have to worry about refinancing out if you're kind of pressed for time. And it removes the bank altogether. Normally, there's like no or very low kind of qualifying of you. If you have credit stuff that you're concerned about or other things, it depends on the individual seller. I also do a lot of seller financing with my like listings. We normally, not so much the last year or so, but a lot of times, especially with my higher price listing, my luxury listings, a lot of times we do seller financing because the folks who are buying those are often entrepreneurs, and they're, way into the jumbo land. So jumbo pricing land. So they don't always qualify for regular loans because they're entrepreneurs themselves. So we've done a lot of seller financing too with our own listings. So always keep that in mind if you're working with a property that's maybe more unique, maybe won't comp out. If either they don't have a mortgage at all or their mortgage is low enough, they might be open to seller financing as well. And I've always gotten my full commission upfront, paid upfront out of the down payment, and it's worked really great. I had a seller who was selling multiple homes in a bundle, which sometimes a lot of investors they don't want to bother selling individual houses. There's lots of investors out there, old school investors who have been investing for a long time. They might own 10, 20, 40, 50, 100 single family homes in your area. And then when it comes time, they start to divest of those things, but they don't necessarily want to sell them one off at a time. So sometimes you'll see where they're offering like 5 houses in a bundle or something like that. I actually listed something like this, and 2 or 3 buyers kind of flaked out. And I told my seller, I said, all right, listen, if you're interested, I'll do seller financing with you. He was offering seller financing on the bundle. I said, I'll do seller financing with you. We're going to apply, my commission at the time was 6%. I said, we're going to apply 6% to the down payment. You're going to cover my closing costs and put it into the loan, which it wasn't very much because it's seller financing, so it's not quite the same. And I got a 90-10 loan with him. So I came to the table, I don't know, 10 or $12,000, something really, really low for multiple houses. Multiple houses. And so I did really, really well with that. And then I just sold them off individually. A lot of them I never renovated. I never renovated. I just bought them with a good enough cushion. It is important if you ever go down that route of getting a what's called a portfolio loan where they're holding, or a blanket mortgage where they're holding several properties in one mortgage. It's very important that in the mortgage you are allowed to sell one property off at a time. And the way you do that is you determine the basis of that property when you get the mortgage. So when I bought with this gentleman, we determined the value of each individual house. We had a spreadsheet, and my agreement with him was I had to pay off 150% of what I thought, what we determined that was at the beginning. Because remember, I bought really low, so that he wasn't stuck at the end, potentially with equity still being owed and there's no more assets. So we kind of front loaded it, but not all blanket mortgages will allow you to sell off individual properties. So that's just file that away for keeping in mind. So the things with seller financing, that's great. Like I said, low, if any, qualifying standards, like very low, if any. Sometimes they do want higher down payments. It all depends on the situation. But it can be really great when people have a lot of equity. Maybe they have no mortgage on their property and they're motivated. Often you can offer, maybe even higher than market rate and say, give me a 30-year amortization and at least a 2, 5, 10-year balloon, depending on what they are. Or like I said, I've even had up to a full 30-year amortization with no balloon. Balloon just means you have to pay it off earlier in 2, 5, 10 years, something like that. But it gives you time to do what you need to do. House hacking is another thing. If you're already midlife and you're settled in your house with your family, house hacking might not be for you. But if you're younger or you're single or you're really driven, house hacking can be awesome. That's where you are buying a 2, 3, 4 unit property, or, potentially a larger multifamily, and you're living in one. And then you're renting out the other units that's going to help pay for your mortgage. So, like I said, I refinanced out a property to buy this farm. That was a property that had 2 units. It was actually 2 separate houses on one thing that I bought with private money. I lived in one, I rented out the other one. With appreciation, I was able to refinance out to put the money down on this farm with a non-QM loan, with a bank statement only loan. But now I have 2 houses still over there that can be rented out that I can enjoy. I'm going to probably do Airbnb with one, and I have a long-term tenant in the other one. And those mortgages, those rent payments are paying my mortgage over there and created the down payment over here. So think about house hacking. If you're gonna do house hacking and you're gonna use traditional financing like FHA or something like that, or even conventional, you normally have to live in that unit for 1 year. So if your goal is to house hack up, meaning create a lot of investments in your portfolio, you have to live in each unit for 1 year. That's assuming you're going to hold it and continue to rent it, not sell it. If you're going to house hack up to get the appreciation out of it, you're going to have to live in it for 2 years to be able to get that tax write-off for your home residence. So just remember, there's a little bit of rules, but there are some people that have just basically house hacked them way up. But I would say that I did that. In 2017, I bought a little under $200,000 house, needed a lot of work. I put the work in, sold that, and that was with a non-QM loan too. Sold that, took the money out of that, bought those 2 little houses over there, lived in one, and then like I said, refinanced those, took that money out, built this farm, and then financed a lot of the renovations along the way with that blanket portfolio properties that I was selling off. So the upside, excuse me, with house hacking is you often can qualify for FHA or VA or conventional because they will use 75% of the income of the other units towards the income you need to close. So if you find a fourplex, they will use 3/4 of the other 3 units as your income. So you need very, very little income on your taxes to be able to show to close. And if you're doing conventional FHA or VA, you can often have as low as 5% down. So it's like a very good way to get into investing if you're flexible with where you live and you're okay with living in a 2, 3, fourplex or something like that. The cons are you're a landlord and you're going to be living next to the people are landlord of. So you have to make sure that you have decent people who are your tenants. But I haven't had a problem with that. I'm on, I think, my 4th round of tenants, and it's gone really well, as far as that goes. So that's a way that you can actually do traditional financing with a 30-year fixed mortgage, but having low income to show. So a couple things that I think agents have an unfair advantage of as far as investing. We're often first up when we're talking to people, when we're seeing things before it comes up to other people. We're also talking to other agents all the time. We can be talking to other investors all the time if we get involved in our local real estate clubs, which I highly suggest you do if you're interested in real estate. We have the direct relationship with sellers. Like I said, I had that seller who was selling investment bundle. I truly, truly tried to sell it for him. It didn't work out. And so I was able to say, hey, here's a solution that's a win-win for both of us. And now he's somebody that I can go to for future deals. What else do you have? Things like that. We're on the ground. We have like the most really good knowledge of our markets. We have all the tools to be able to analyze markets that like even the regular investor on the street might have access to. And there might be additional tax benefits because we're agents. So because we're actually seen in a different class for income tax calculations, our real estate income, if it's rental, isn't necessarily seen as passive. So we have a little bit better taxes on that, but you'd have to, talk to your tax planner to go over that. At EXP specifically, we have express offers, which is like the best of all worlds because this is how you can get yourself in front of motivated sellers all the time. Express offers is the same thing as like Open Door or something like that, where they're offering to buy distressed properties or motivated sellers who don't want to do normal things to a property to get it ready to list and sell on the market. It is free to get certified with express offers. You do it through EXP University, then you can be in that program. And so what that allows you to do is now you have a whole suite of marketing tools to get in front of sellers who might have distressed properties. Distressed being they themselves can be distressed, the property itself can be distressed, and now you can offer them 3 options. Like, hey, Mr. and Mrs. Seller, or whomever, here are 3 options. You can choose based on what you need, what you're looking for. If you're looking for like the fastest transaction possible that might close very quickly with the least hassle possible, we can put you in express offers, because what express offers does is they have institutional buyers who are not individual people, but big institutional buyers that are become like a marketplace of buyers that we can share our express offers listings with to see if they're interested. And if they're like, no, I need a little bit more money out of this, you can say, okay, then we can, look at doing, sorry guys, hold on. The traditional listing in the MLS, where we're going to list it in the MLS. You'll definitely get more money out of that than you would with an investor, but it's going to take you a little more time and you might need to do some things to the property, either because the buyer wants that if the buyer's buying with a loan. Or the third option is if they're just trying to not have the hassle of the property anymore and they're less concerned about having immediate cash, say, or the third option is I'll pay you full list price or full list price plus a bonus if you'll do seller financing. And if you'll do seller financing and then you negotiate the terms. So express offers is like the best possible tool to get in front of tons and tons and tons of these types of sellers that will spin you off express offer deals, spin you off potential regular MLS listings, and spin you off seller financing deals. This is like the best of the best of the best. So the next thing you want to do is you want to make sure that you build your investor network. Just like with real estate, you want to have contractors available. You want to have specific mortgage people or lender people available. I would definitely get involved in the local REIAs, which is real estate investor associations. Every town just about has some kind of REIA. They probably meet monthly in person somewhere. They might meet more than monthly in person. Go to those things. Join their groups. If they have a group that has some small annual fee, join it. If they have meetups, go. If they have Facebook groups, go. Like, this is how you learn. This is how you build relationships. This is how you also possibly start tapping into partners who might do deals with you. There's also wholesalers, depending on your state, there might be wholesalers. And what wholesalers do, they're not buying property, but they are like the bird dogs. They're getting out and talking to sellers. They're putting properties under contract, and then they will transfer that contract to the end buyer, which could be you, for a fee. So if wholesaling is allowed in your state, you want to get on all the wholesalers' email lists for the people who do wholesaling in your area, because you're going to have a ton of deals come across your desk all the time with wholesalers and bird doggers. If you're going to partner with people, and a lot of people when they're first getting into real estate investing, they do partner with people, and they partner with people, maybe those people have the money and you find the deals, or maybe those people are contractors so they can do the renovations for less, as and their payment is being part of the deal with it. So if you're going to partner with somebody, always keep your mind out there about partnering, because now you can leverage your strengths and not be kind of shackled by your limitations that you might have right then. But make sure that you put together a real legal partnership as an LLC. Be very clear on your agreements, very clear on everything, very clear on exit strategy, and all that, and check your partner out. Make sure, just do whatever due diligence you need to do to make sure, because there are, in the real estate investing arena, there are, a little bit of scammers out there, or gray on the ethics. So make sure you check, but there's very good ones out there too. There's very good ones out there. A few more final things, and then we're going to wrap it up. Bonus strategies, BRRRR, that's what I was talking about before. This is a really great strategy. You buy a property that needs renovations or some kind of modernization, freshen up. You rehab it, you rent it out, you refi to get your investment out. So now you've got your original money out, and then you take that money out to do your next BRRR, because now you have a property that is paying for itself with its rental income. Another one is lease options or arbitrage. That's where the person still continues to own the property. This might be a solution when you're just getting your feet wet. Arbitrage is for short-term rentals and things like that, where you rent it, but then you're going to rent it out short-term in agreement with the owner, but maybe they don't want to sell, but they don't want the headaches right now, so they're open to something like that. That allows you, again, to kind of dip your feet in. And then if you have a very healthy 401k, there's actual loan programs that allow you for your 401k to basically become your bank, either for your down payment or for your whole property. Depending on how much you have in there, you have to go through the special programs that allow that 401k to do that, but that's another option if you have a healthy 401k. So real fast, I'm going to read this real fast. I threw this into ChatGPT, and all these assumptions are going to be on the worksheet that I share with you. But I just said, okay, if over 20 years I was putting the equivalent of $1,000 per month in the S&P 500, and $1,000 into real estate. If I was doing that for a whole 20 years, and then every year it wasn't, I mean, every month it wasn't $1,000, that $1,000 increased with inflation on both sides. If whatever money came out of the stock market portfolio or real estate, I put that back in the property, and I had a 10% property manager so that it's a little more passive, just like stock. How do they compare? And I had ChatGPT use the average appreciation in my area, an average of, I think, 6 or 6.5% mortgage, 30-year mortgage with increase of 5% per year. How do they compare? And I'm going to give you these prompts so that you can throw this into your own ChatGPT to see how these things would differ in 20 years from now. And it's quite large. So with the average annual return of the S&P at 7%, and the average appreciation of 5%, the portfolio would be worth about $1 million in 20 years, and the real estate portfolio would be worth about $4 million. The big difference is real estate is leveraged, meaning when you're putting money in the stock market, you're only putting in as much money as you have. Whereas if you're investing in real estate, as long as you're not buying it all cash, you are leveraging often, 60, 70, up to 80%, or if you're house hacking, you're doing, conventional where you've got a 5% loan, up to 95%, where you're still getting the appreciation on the whole thing, but your cash in is a lot lower. And then taking rents and everything else that don't need to be needed for like upkeep of a house, replacement of the roof and things like that, putting it right back in the property, it's a significant difference. So I would encourage you guys to, when I give you this spreadsheet, look at that. And then the cash flow at the end of the 20 years is also significantly different, of what investing in the stock market would give you, that you could use and not drain down your stock portfolio, versus at the end of the 20 years, what you're getting in rents for retirement income. Of course, there's ups and downs of the real estate market, ups and downs of the stock market, but my point is you can really do very, very well for yourself. You're in this business. You're in real estate. You should be also thinking about how can you become a real estate investor as well. So your next steps would be assess your CAS credit and connections, get an understanding of all of that, kind of look at the different financing strategies and see which would fit best with you where you are right now. Definitely everybody should get Express Offers certified. I would join at least 2 investor groups. You can join a local investor group and a national one. You can join 2 local ones, but get involved in investor groups, because that's where you're going to start hearing things. You're going to start seeing people be really successful who don't have nearly the benefits that you have, which will inspire you to go out and do things. Start small, make it a goal maybe to get your first property within the next 12 months. And then the other thing is I wanted to throw in here, I always try to have also a plan B, meaning if things go sideways in the real estate market, in the economy, with my health, with whatever, I want to have a plan B where I can exit, right? So for me, that normally means not having more than a 70% loan, because you can always sell and still have some money to pull out if you have a 70% loan. But always be thinking about a plan B. Or with those other, when I said I bought those houses from that gentleman, I had planned to renovate them all. That was my original thing, was to renovate them. I would have made 2 times as much or 3 times as much. But I ended up moving because I found this other place, which was an hour away. So it didn't make sense to be driving an hour up and down to renovate them. So my plan B was to sell them as is, and I still made money. I think one I broke even on, but I still made money on all the rest. So on the whole thing, I made a lot more money. So I would just encourage you guys, don't just sell real estate, really think about owning it. You have the access. Now you have a bunch of strategies. Now let's go get the keys. So like I said, I will open it up for questions if you guys have any questions. And then I'll also give Lovely a couple worksheets, one worksheet on the different financial strategies you can use, and one how to use ChatGPT to kind of figure out the difference of stock market versus real estate in your area. So let me stop sharing. So Any questions on any of that? Oh yeah, so Sean is our real investor over here, and he's like, he loves seller financing, private lenders, and hard money lenders. Absolutely. Nikki said, great info. Thanks so much. Awesome. Any other questions? Were you guys inspired, excited? Make you think a little differently about how you can use your real estate license?
Well, was that recorded so I can actually review that again? That would be tremendous, but
Yeah.
great. Thank you. It's fantastic.
I would just encourage you. I mean, I'm 56. If I did this for 20 years, till I was 76, which I don't plan on working for 20 years, but I think the calculations were I would end up with with that $1,000 a month plan. I think I would end up with like 7 or 8 houses. Just by doing the $1,000 a month and then the $1,000 adjusted for appreciation, and then anything rents that are above that. And then that number I showed you was the equity, meaning with all the mortgages paid off. So that the idea would be then you start using your rents as your income after, you've built your portfolio. And I know a lot from my investor groups. I know plenty of people who have 20, 50, 100, just people like me and you, just regular people, 20, 50, 100 single family homes. A lot of times, however, they start getting into bigger things. Like once you've already done 10, 20 homes, single family homes, a lot of people start getting into multifamily. They start getting into storage units, things like that that are really good or RV parks, trailer, mobile home parks. Those could be very cash cow heavy. So, all right, guys. No other questions?
Janie, I'll just add a comment. Uh, Thanks so much for doing this, and thanks for you and Stacy always putting these trainings together. But you know that I love investing, real estate investing. And the one thing that you mentioned, which has been really powerful in my real estate journey, is absolutely leveraging the fact that you're a real estate agent. And like you said, if you're working with a seller, whether you're working with you're looking to buy a house on the market, kind of like you mentioned, you were working with your seller and at the time you were charging 6%. So there's already a 6% discount built in where you can leverage that. You can even get, use that as a down payment, such as Janie did. Or, if you're really negotiating a property that you want, you can say, hey, Mr. Seller, if you reduce the price by whatever, 3%, 2%, 4%, whatever they were going to initially charge, they knew they were going to pay that anyway. And you can kind of use that as a built-in discount to win the offer. I've done that several times. So
Yeah.
I think that's a super powerful tool.
Yeah, I got Express Offers certified. I haven't yet started because I've had so many things going on. I couldn't add my investment stuff more than what I've done in the last, whatever that was, 8 years. But I 100% plan to massively leverage that Express Offers. Because like I said, now you can give them 3 choices. And
That's
a lot
right.
of times they never think about seller financing. They never think about it.
Yes, yeah, that seller financing is powerful. And just wanted to piggyback on Lima One. You mentioned them. If anybody else, they're a great lender, great resource. Like Janie said, you don't have to show a ton of income or anything like that. They're looking more or less at the property. So definitely check them out. They're a good resource. Thank you,
Yeah.
Janie.
No, thank you. Thank you guys. So, all right. Well, any wrap up, Stace, for the meeting?
No, I think you did a great job. Thank you for all that information. I learned a ton. And I
Good,
don't
good.
know that much about private money and things, so it was awesome.
Well, I wanted to share it.
All right,
mostly-
guys, well, have a good day. We will see you hopefully tomorrow. Oh, sorry.
Oh, no, I was just saying so many real estate agents think that they can't get into investing because they're still thinking of loans in the same way as a resident buyer would. And so they think, oh, I can't because I already have a house and my debt to income is this or whatever. They're not thinking of just, we as agents often don't put our toe into the investing side, so we don't understand all those options. So that's why I wanted to share that people realize there's a lot more ways that you can buy houses than you, there's a whole different world. As big as our world is, it's probably bigger. As big as our world is with retail front of the bank, home sales, there is equally as large of a world of opportunities, lenders, things in the non-owner occupied, non-regular real estate world. As big. And sometimes we don't realize that. We just think it's what we've seen. So, yeah. All right. Bye.